So Opendoor just reported earnings today. It's been a bit of a tough run for Opendoor since this past summer, when there was pretty steep and rapid decline in home demand, which led to the same happening to home prices. And Opendoor was left with a lot of inventory that wasn't worth as much as it paid for it, and so it's still feeling the aftershock or the after effects of that decline in inventory value. And Q1 earnings came out today, beat on the top line, beat on the bottom line, at least with the adjusted numbers. So highlights revenue of 3.1 billion, gross profit of 170 million, although that includes a valuation adjustment. The adjusted gross margin was negative 3.3%. Adjusted EBITDA, negative 341 million. They purchased 1,750 homes, and they had an inventory balance of 2.1 billion, down quite a bit from year over year. The guidance came in sequentially much better with regard to the adjusted EBITDA. So revenue is almost cut in half. Q2 revenue guide of 1.8 billion, down from 3.1. But the adjusted EBITDA guide was negative 190 million, an improvement from negative 340 in this quarter. So I think globally, it was a pretty short call. There were not a lot of questions, and they kind of went through it. It sounds like they're very kind of buckled down and focusing on righting the ship. But I think that there was a lot of interesting strategic points and pearls that they mentioned that are worth talking about today. So some of the biggest ones I would say are that Opendoor said that they plan to maintain double-digit spreads on homes that they purchase for their balance of 2023. And in conjunction with that they're planning on acquiring roughly 1,000 homes per month for the rest of the year as well. I think both of those are probably the biggest updates from the quarter, because it's strategically very different from what they've done in the past. And Carrie was pretty explicit about how many homes they intend to purchase. And obviously 1,000 homes a month is subscale relative to what we have come to think of Opendoor as. But either way, lots, I think, here to talk about. And I'm happy to dive into any of these points, but maybe we start just seeing if anybody has any questions. And if not, then I'll kind of continue on.
Yeah, if you have any questions, feel free to request to speak, and we can bring you up here. But maybe I also took some notes. Maybe let's start with acquisition pace. Yeah, that's quite interesting. So Carrie said they will stay at 1,000 homes per month for the remainder of the year. But at the same time, I think there was a follow-up question on costs and how they will evolve next year. So they kind of mentioned that they will only increase marketing spend Q1 2024. And basically with that increase in marketing spend, they will go to kind of the 2019 levels of a $10 billion run rate, where they want to be adjusted income profitable by mid-2024.
Yeah, I think one of the tough parts of that for me, or the part that I'm kind of scratching my head on the math about, is if you're acquiring 1,000 homes a month, the most homes you could sell in a quarter, I mean, just mathematically, is 3,000, right? And so if you're selling 3,000 homes at $400,000 a home, that's 1.2 billion. And so if you're getting 10% adjusted gross margins on that, let's say that you're getting 120 million in gross profit. 90 million is currently the OPEX, and that doesn't include selling or holding costs, which is usually 4% of revenue. So basically what they're saying is that, for Q3 and Q4, even if they have really excellent gross margins, they will not be profitable quarters by any stretch of the imagination. And even if you get to the 10 billion run rate, you would need to have, I mean, that's still only 2.5 billion a quarter, right? So you'd need to have probably closer to like 10 to 15% gross margins if you were going to be break even at that level. So, I mean, the spreads have to be pretty wide for that to make sense.
Or bring down the cost, which is what they mentioned they're working on.
Right, but they're not going to be bringing down. I mean, they said that the OpEx was going to be probably a little bit higher next year.
Especially with marketing.
Yeah, but to your point, there's parts in that, like selling and holding costs that go into the contribution profit, that it seems like they're trying to get stable improvements, 100 basis point improvement in cost there specifically. So yes, if they were able to add 100 basis points of cost savings, that'd be material for a $10 billion run rate.
But basically, they set the expectations that they're not gonna scale up this year anytime soon. They want for mortgage rates to stabilize, which means they don't have to be much lower. It just the volatility has to go down, right? They want the housing market volatility to normalize and get sellers back. The big problem is in the market right now is there's not enough sellers, and they expect that to get better next year. That's a big assumption.
Well, this is also, I thought, one of the most interesting parts that they mentioned strategically. You just were talking about how there's no sellers, right? Inventory is locked up. And they talked on the call about this opportunity to identify latent sellers, or sellers who, homeowners who plan to sell their home at some point, but it wasn't the right time, or they didn't have the energy, or they were worried about home values, whatever the reason is, right? With their exclusives model, they're finding ways to convert those latent sellers into actual sellers. And I think it's an interesting commentary on a product that is desired right now, probably more than most other cycles, because inventory is so scarce and so locked up. And so if you can get these people off the sidelines because you've made it so easy for them to sell their home, and they can accumulate offers, and people find a value in that, then it's potentially a way that you can break some of that standstill or housing ice age in these local markets.
Yeah, that's a great transition to exclusives. So let's talk about a few things that we learned about exclusives on the call. First, they revealed that they're currently focusing their efforts of the third-party exclusives on Plano and Texas, which we kind of put together with Dallas, because that's how it's listed on the website. So we've seen most of the third-party activity, while they had some initial third-party listings in Austin and Houston as well. It's basically just Dallas right now, which now they revealed is basically in Plano. So that's where they're experimenting with all this third-party stuff. And they revealed that almost 60% of sellers they pitched in Q1 on the third-party exclusives, 60% of those sellers agreed to enroll into the program, which seems really high, 60%. And within the quarter, they drove to about 3% of listing share in Plano. I'm not sure how big the market is in Plano. Like, I don't know if it's like thousands of homes or it's a relatively small market. I mean, it's not a Houston or a Dallas. So, but yeah, 3%, still a good number that they did in 3 months. And basically, they're focusing right now on making sure they're perfecting their customer experience. And to do that, like you said, they need sellers. And right now, it's not a great time to get regular sellers. So they really focused in on those latent sellers that really don't know if they actually want to sell, and try to convince them to list on exclusives. My questions there are like, how big is that market really? Like, imagine they really double down on latent sellers and roll out nationwide. Is that, I mean, it's a net add to home inventory. They're unlocking a new market. But what do you think how big that market could be?
It's a good question. So you were just real quick, you were talking about the size of Plano. Zillow currently has 220 homes in Plano for sale, for whatever that's worth. So not huge, but not tiny either. I think I've always felt like this sort of third party aggregate offers for your home is sort of the dream way to at least start your home selling process, right? Like the activation energy is almost nothing. You get to accumulate all these offers. You get to be in the driver's seat. I mean, like you automatically have a way out or a way to get cash in your pocket no matter what. And so I think in that regard, in all of those different facets, it's a potential improvement over the traditional experience. But that being said, I don't think it's meant to replace the traditional experience. So many of these different products or ways that Opendoor is trying to improve the transaction is at different steps along that transaction process. So it's the same as list with Opendoor, right? Like if you're a homeowner and you go through the exclusives program, you don't find a offer that makes sense. You just don't think that there's a good value there. You can then move down the funnel into list your home with Opendoor, right? And maybe you convert a home buyer through that. Maybe you don't. But then, if that doesn't work out, you can just take a cash offer from Opendoor, right? Like there's so many different ways that they're coming at this, and none of their different products are replacing the entire traditional real estate transaction. It's just adding a few more frictionless offerings that you can use to bypass the traditional real estate experience if the traditional real estate experience is not working for you. And even still, Opendoor is iterating with the traditional real estate experience as well, which they talked about in the call with all their partnerships with agents. It seems like they're really doubling down on that, which I think is good. And something that we have to continue to monitor. It's probably pretty good unit economics as well, relative to first party. But yeah. I think it's an interesting time.
Let's talk about partnerships. But last thing they mentioned on exclusive is the timeline we should expect. They reemphasized that they're right now in building mode. They're nowhere close to scaling, so they're going to continue to ramp up into 2024. We should probably see. At least that's what they mentioned last earnings call, a few new market launches by the end of 2023, and they're targeting a more material volume potentially in 2025. So all of this is really small scale. What I'm interested, a follow-up question would be, if I would be an analyst, is like, if they have exclusives rolled out in multiple markets, they obviously going to also list first-party exclusives, which they don't count into like their progress of the third-party marketplace or the exclusives marketplace, and that will drive down costs as well, right? They're still selling a lot of homes through exclusives where they don't pay a seller commission. So that will probably somehow show up in 2024 as well, which they probably don't put into this material volume here. But yeah, let's talk about partnerships. There was a little bit of news on the partnership side and how they are really doubling down on those low cost acquisition funnels. One reason probably is being that their conversion rates with those high spreads are really low. They were at 10% last quarter, and now in this quarter in Q1 they were I think closer to 15% because their spreads came down a little bit. But that means you can't really spend a lot on marketing if that doesn't end up in somebody selling, and only 10 to 15% of the time. So they are doubling down on the partnerships, One being Zillow. Zillow went live in the 5 largest markets in Q1. They also said that their Redfin and Realtor.com partnerships that basically look the same as the Zillow partnership are rolling out now nationwide. And they mentioned on their agent side that 50% of their agent referrals are now coming from agents that did business with Opendoor before. That means they have a substantial amount of agents that just regularly refer customers to them, which was quite interesting.
Yeah, I think that's a great summary of kind of what happened on the call at a high level. Unless there's any other topics that you have, it'd be great to take some questions, talk to some people.
Yeah, please raise your hands. Let me check if we get any questions on the Discord. I mean, we have a question here from in the Discord from Corder. He says, "I know that now is slow / risk off, but when will things roughly be back to normal next year if the target is only 20% of what it was?" I'm not sure what he means by the question, but I guess you could summarize it like, when are we going to be back on track on that $50 billion run rate revenue they targeted in their investor slides like a year ago?
Yeah, I think he's touching on probably one of the most important questions about Opendoor at this point, because Opendoor has moved from this ubiquitous, will offer on any home in their buy box relatively close to the home's value and then resell and try to make all the margin and the transaction fee, to double-digit spreads, very conservative, low conversion rates, much smaller market. And so I think the question that most of us should be thinking about is the model still interesting? Is the model as investable in that situation? Because it's not Amazon in that situation, right? It's more of a boutique offering. And I guess I don't mean it as, is it still an interesting model? I mean it as, does the company believe that they can get back to that situation where they could offer on most homes, and the TAM was enormous because it was most homes in the United States. If there is a path back to that, and they can structurally reduce costs in a way that's not just a pipe dream, it's something that actually could be done, or at least close to what that vision was, then I think it's still a very interesting model and worth staying in and paying attention to. But that's probably what he was trying to get at, is like, for the rest of the year, we're going to be at this very subscale level. Through 2024, our run rate's only going to be 10 billion. That's, we've been there, done that for Opendoor, right? But is there long-term aspiration still to be a much, much, much larger player than the current iteration?
It's a good question. I assume the answer would be yes. But like, to reiterate what we saw in the slides from last year, and I hope we will see a new investor deck next year that is closer to where they are right now, or on the way to where they're going at that point. They had their path to $50 billion run rate mapped out with 100 markets and 4% market share. Still seems attainable, but it got pushed back by at least 2 years, I guess, from the initial timeline.
Yeah, agreed. It's an interesting question. I think Haral wanted to to, 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 think the mic is muted.
Oh, okay. Sorry. One thing I find it interesting is that once these properties are purchased, why there is not a talk from them about until those properties are sold, can they not rent it and generate a stream of revenue? It just seems odd to me that, okay, this is what we are going to purchase and this is what we are planning to sell. And everything is dependent on the interest rate and a lot of external factors. But there are a lot of other creative ways they can utilize those assets, which I don't hear as much about unless I'm missing something.
That's a great point. So just so you know, in early 2022, like January 2022, I met with Daniel Murillo at Opendoor for the first time through investor relations, and I pitched him a version of that exact product. So we were tracking Opendoor's performance at the time, and they had all of these homes that were long held for a very long period of time, and I questioned whether or not it would make sense to funnel some of those homes. If those homes were not getting a certain number of visits or attention or offers, they sort of move into this long-term funnel where they're not only listed for sale but also listed for rent. And then those homes are rented. You earn some income on them and wait for them to appreciate to where you bought them and then sell them. And Daniel did not love that idea. And he kind of mentioned that, was very instructional, that the debt that Opendoor has is meant to be it's meant to be short duration debt. And so if you're using that debt to finance homes that you're then renting to people, it's sort of against the covenants that they set out when they secured that financing. And so that's part of the issue, not to mention the operational difficulty of alternating between trying to be this asset light technology player and a landlord at the same time. It's quite expensive, and I think it's easier said than done. But I agree, it would be nice to have some sort of solution for these longer held homes, so that they can make money on them while they're waiting to sell.
Right. Thank you.
All right, we have another question here. One from Corda. He's asking, what's going on with all those high margin services? It's never asked about, it never mentioned. It was only a year ago. It was the key part of the story, contributing to up to 22K per home. Any sort of attach rate progress there you can share? Is this still part of the thesis? And he's sharing here the slide from, again, the investor deck, where we see title and escrow being $2,500 of target contribution margin per home. Then we had home loans, which obviously got discontinued, which were supposed to be $5,000 of target contribution margin per home. We have buy with Opendoor, and in the future, maybe home warranty, upgrade and remodel, home insurance, moving services.
I think those features are a ways off. Title and escrow is the best of all of them, and they've recently made some moves with title and escrow to double down on that, but their high margin T&E revenue is down over the past few quarters because they're not acquiring as many homes, and so they're not able to realize that margin, that profitability, because they're not acquiring those homes. As they begin to ramp up again, I think it'll be a more material piece of their earnings and revenue. So that's something to watch. Obviously mortgage isn't happening. I don't see anything with insurance or warranty right now. I was impressed to see that they renovated 2,500 homes from the Q2 offer cohort starting in Q4. I mean, operationally, that's very complex, and I think it speaks to the fact that they actually have invested and continued to invest in the operations team that can renovate and repair homes. So that might be something that comes sooner rather than later. But in the meantime, it seems like Carrie's number one priority is to get first party right.
And on home loans or mortgages, they still have the partnership with Law.com. So they offer mortgages to, like, as part of Buy with Opendoor, but I'm sure they're also offering to movers that are selling to Opendoor. So they probably get a decent revenue cut there. It's probably not $5,000, maybe more like $2,000, $2,500. But it's basically no cost on their end to just push them down a different funnel, and it probably like improve the experience because they have a tight integration there. Buy with Opendoor is still going on. They did a lot of changes to that program. They also have quite a big team investing into the infrastructure of building an e-commerce checkout for real estate, which would mean Buy with Opendoor, but also the future of Opendoor exclusives. And I assume a lot of that renovation and upgrade and remodel infrastructure that they're building, and maybe the muscle that they've flexed here with renovating 2,500 homes, will be part of that e-commerce experience. Like, imagine you could like just customize the home you're buying with Opendoor or on exclusives while you're checking out. That is something they have talked about in the past that might be a bit on the back burner right now, but we'll probably get there. And yeah, home insurance is something they experimented with before, warranty as well. Maybe they're also offering some of that through like some referral program, but none of them are done in-house right now. We have a question here from Steven on Discord as well. He's asking, can you please talk a bit about geographical diversity in the most recent purchases? It seems that they should be in a better position to ramp up purchases sales back up if they have a stronger foothold in more than just a handful of markets. Maybe put another way, how many of their 53 markets are fully ramped? Tyler, do you have data to open right now and can give a bit of clarity here?
I am opening it up right now. Let me tell you. I guess we can look at Q1 data in particular. I don't know. I mean, it still seems like there are few places that they're buying quite a few homes, but most of them are very few. Yeah, so I haven't seen too much change in the strategy there. I mean, Atlanta's the most, and then other than that, only Phoenix, Charlotte, Houston, Tampa, and Dallas had 100 or close to 100, and then it really drops off after that. So I'd say probably of the 1,700 homes purchased in Q1, maybe 70% of it were in the top 15 markets. Yeah.
We shared this chart on sales on Twitter before for Q1, so I probably should share chart on purchase as well. It looks a little bit different. Like you said, Atlanta took over Phoenix. We also saw Texas go get a bit weaker. Like Dallas and Austin were quite strong markets in the past. I assume they're a little bit riskier recently. That's why they're not purchasing as much there. And I don't know if you saw, Tyler, I added the years the markets have been launched to Datadog as well, which is quite useful. And
I I had no idea what that was. I was like, what? What does this mean?
It's the year that the market launched. So yeah, the
Cool.
earliest markets. Let's maybe take a look at 2021 markets, which should be kind of subscale at this point. Greensboro is doing probably really well for a 2021 market. Like it's overtaking markets they launched in 2018. Some of the newer markets from 2022 are just really small right now, like New York, San Francisco, Albuquerque. They're hiring in those markets. I saw a job listing for Albuquerque, New Mexico. So they probably are planning to invest more there. But yeah, I think being set up in 53 markets and probably underutilized in many of them will give them a good platform to scale back up.
Yeah, it's just interesting because even at Opendoor's apex, like when they were just buying homes left and right, it was still pretty concentrated amongst a few key markets. And I think in markets like Atlanta and Phoenix and Dallas, and Orlando and Tampa, Houston, I think in those markets they'd really aggregated these cost efficiencies and really had a deep understanding of those markets. And that's probably why they leaned into them so significantly, rather than aggressively growing other ones. But since Opendoor has gone public, I don't know if we've seen a new market become a prime market for them, or become a material portion of the revenue.
All right. Do we have any other questions? Maybe one last thing. Oh, we have a question here. Great. Hey, Aaron, do you have a question for us?
Yeah, how are we going, everyone? Can you hear me all right?
Yes, we're doing great.
Nice. Yeah, I guess my thoughts are, nothing's too new what was reported today in terms of especially the last earnings release. There's been a reset. They've acknowledged a lower run rate. They've been conservative, high spreads, low purchasing volume. So, a lot of that was discussed last quarter, including shaving off 100 basis points and additional cost, etc. So, my thoughts are what's needed now to increase conviction in the business over the next few periods? Is it as simple as saying, if they can hit adjusted net profit on a $10 to $15 billion run rate, that's all that's needed? Or before the business or the stock can actually take a much higher leg upwards, because it could really just trade relatively flat for the next year if you are having to wait till mid 2024. So yeah, it's more just where my head's at in terms of thinking versus a question. But what do we need to see over the next 2, 3, or 4 quarters? And when do people start getting a lot more bullish on the business? I'm personally impressed with, after the big stuff up, where it's gone, and they are executing as they say, but it still doesn't feel like it's enough for people to have conviction in this business. So just keen to get your guys' thoughts.
It's a great and tough question, because I think a lot of people who were bearish on Opendoor from the start feel probably appropriately vindicated for that. And I think a lot of the people that were very bullish on Opendoor have since retreated because of what happened this past year. There's a lot of boxes that need to be checked on the way back, and I think we touched on a few of them, which is really just that the first party business is not just a money losing business, that it actually can be valued as something, and that takes a certain amount of scale and a ton of discipline and much more cost cutting, I think, for it to be a stable business. But then you start to get into what are the things that could really excite people on the sidelines, and I think that's the third party marketplace, number one, because that is a ubiquitous capital and asset light model that could scale very well, especially with these partnerships. And then you also start talking about their Opendoor's product for landlords. So they're them being the infrastructure layer for landlords, for REITs, for all these institutional players that they work with. And truthfully, those relationships and that product feeds third-party marketplaces as well. So they all work better together. But if that can scale, and if the third-party marketplace can scale, the first-party marketplace is much better insulated, and I think the business is viewed as more investable. But again, to your point, those are down the road items. Those are not really 2023 milestones. But I do think that longer term, if they continue to make progress, those would be drivers of the thesis.
Yeah, no, I think we're on a similar page in terms of what's needed to drive it forward. What I'd find interesting is what are they coming to the next earnings release with that's not similar to this or the last one? So in terms of their commentary around performance of third-party players, say Zillow, nothing changed there. And then in terms of, say, 3P, not a lot has changed there. So this is what's interesting for me is, what can they bring? And so part of it is, I'd still love to see them getting in front of the camera a lot more, whether it's podcasts or similar. Because if you only hear from them once a quarter and you turn up and they haven't actually improved the Zillow integration or increased purchasing, etc., then I think that can leave people, especially analysts, leaving, not thinking a lot's happening. And I'd just like to see still a lot more hands-on stuff happening from the business, but I guess we'll tell over the next few quarters. But overall, I think, they've done exactly what they said they would, so you can't hold that against them.
I mean, they were not great at doing that when the business was going well, right? We didn't hear much from them. There was not much media appearances other than like maybe a CNBC interview with Carrie at the time when she was CFO. Yeah, I agree. I hope we will hear more from them. I assume it's not going to be the case until they're back on their feet and back growing. It just probably doesn't make much sense for them to talk right now. One thing to mention, because I guess you were talking about the valuation, their stock price, and we usually don't really comment on that because it's just impossible to predict where it's going. One thing I guess I can say is like they're valued still for basically bankruptcy. So like maybe it's enough for them to just show that they can make this for the stock price to significantly go up from here. I mean, we were scratching on the we were above $2, scratching on the $3 a few months ago. I mean, I don't think it takes much to get back there. Maybe the macro improve a little bit and like them showing that they can make this. And I think they did a good job with that on this quarter. We will see in the next week how the stock price will move from that. Tyler, any other comments on that?
Thanks, guys.
No, I mean, I I agree with all that. I think you both made some good points about some of the challenges of investing in Opendoor, and then also what can be baffling about the valuation, and yet oh so fitting. But I think it's still a show me story for a lot of people. I think Opendoor still feels internally like they have a lot to prove and a lot to accomplish before, you know, before the end. And I do think that this quarter was improvement, but as we've kind of talked about, it's also what was expected. And I think there's a few more quarters of this where it's like not their best work, but clearly we're moving in the right direction. With Q4 being probably a pretty banner gross margin result as we head into 2024.
Yeah, and I guess on the topic of media attention, we saw Keith going on various podcasts talking about Opendoor, going on CNBC. It probably didn't really help the stock. So I'm not sure if that would really move the needle if we saw like Eric or Kerry going on media tours.
To be clear, we've tried to interview people from Opendoor for a podcast, for a video, to try to tell the story a little bit better, and they've always said no. So, I mean, we're with you. We'd like it too, but it's always been no.
All right, maybe to close this off, one thing that they mentioned, and we knew about this for a while, and Tyler, you tweeted about it as well. They now officially sold off 92% of the homes they made an offer on between March and June, so the Q2 offer cohort. And that's ahead of their schedule, where their prior expectations were 85%, which is really great news. That means we're only getting closer to not have to talk about this Q2 offer cohort ever again. Anything to add there, Tyler? Q2 offer cohort.
Sorry, you caught me while I was taking a bite of dinner. No, I mean I think they're getting close. There has been a little bit of a deceleration in the speed with which they're selling off this Q2 offer cohort, but they're still making progress. I think it's going to be a material part of their Q2 sales, and then 25% or less of Q3.
Yeah, so we are seeing the end of the tunnel here. All right. Thank you, everyone, for joining in. You can listen to the whole, if you joined late, you can listen to the whole thing and probably tomorrow on our YouTube channel. We also uploaded the earnings call and have a transcript of it on the website as well, datadoor.io. We really appreciate you guys always showing up, asking questions, and obviously subscribing to Datadoor so we can continue doing this work and follow Opendoor along as they get back to their prime. Tyler, any other closing thoughts?
Yeah, I mean, thank you guys for always showing up. It's a little tougher to talk about Opendoor these days, and I think investing in general is maybe a little bit less fun than it was in the past. But I still think that this is a super interesting model. We're still trying to be as accurate and fair about the company as possible. And we really like doing this, but we obviously can't do it without you. Thanks so much for the questions and the support.
All right. See you soon.